I had a company that bought a lot of rolling stock that they used to support the business. Buses, trucks, you name it. And on paper, if you were to look at cash flow numbers and do a multiple of 5 or something like that, it would be worth, let's say, $1. But because of all the assets they have to buy from one year to the next to support the earnings of the business, if you took all those assets to market, you forgot what you were doing for tax depreciation, and you took them all to market, the company was worth $2 or $3 because the assets were so big. But those assets only produced a 3%, 4% rate of return for the cash flow. And so nobody would buy the company for $3 because the return on investment is so low. But it's a family-run business. It's been around for a long time, and they want to move it from one generation to next. And we went to a different firm than you guys to do a valuation on that thing, and we got like a 30% discount off the $3, but we got nowhere close to the $1. And it was nerve-wracking because if you took a loan out and you bought the company for the asset value, it'd take you 30 years to pay it off.
Yeah.
So what do you do in a situation like that? It makes if you liquidate it, you would get $3. But because of the cash flow the thing's kicking off over a 5-year period of time, it's worth $1. You got did I stump the band on that one?
No, as far as I know the case you're talking about, because we've talked about that one before. But, I mean, there's 3 ways to value a company. It's called the income approach, the market approach, and the asset approach. And you're talking about the asset approach. You're valuing the vehicles at fair market value to come down to what value. But evidently,
you'd never sell those assets if you're transferring it to children.
No.
You never do it.
But the whole thing is, what they're doing is they're having a livelihood off of this thing, and they're making good money,
and they like the business.
They like the business. Eventually, as far as those kids are going to get tired of it, and they'll probably sell it to a VC group, a venture capital group. That's probably what's going to happen. Somebody that wants to do the synergies and take a lot of these companies,
increase the earnings by pulling them all together.
Yeah, that's eventually what's going to happen at that time.
Okay, this is going to put you on the spot, but let's say you have somebody out there that has a business they think is worth $10 or $20 million, just at that level, and they're going to hire somebody to get a valuation. What kind of costs would they have to get an independent appraisal from a smart guy like you?
Well, I wouldn't call myself smart, but anyway.
Educated.
So really what it comes down, it's on an hourly basis, okay? People try to nail you down to a fixed cost.
Okay.
But it just depends upon, if you do it right, it's going to take you some time to figure out what you've got.
Well, I mean, you're not going to have 40 hours in this thing. You're probably going to have 100
No, it won't.
By the time you're done.
It depends upon the company and the size and the complexity. Okay. I can give you a range as to what costs, and that's usually what I do, is I give them what kind of they want. They want a calculation engagement? Do they want, as far as a summary report, do they want a detailed report? And the higher up the food chain it goes, the more cost because they got more work involved.
Yeah.